everybody. Today we are going to go through our newest house view, WealthVest Rethinking Retirement Q1 2024 in review. We cover the period between January and March. I was just published this past week, and we go through a series of both international and domestic indicators, talk about commodities, then we kind of end our discussion going through changes in some of our portfolio analysis research, as well as touching base on annuity and structured sales and how they stand today. Tim, without further ado, kind of let's get into this quarterly document.
All right. Thank you, Drew. I'll run through the first few pages here, talk about what we saw happening in Q1 in equities, in fixed income, and commodities. And then Drew is going to talk a little bit about what we saw internationally and also talk about the annuities and structured products piece here. So look, what we wrote here on page 3, if you could push ahead there, Drew, is that AI was about two things, I think mostly. It was about demand. It was about the surprise that demand hasn't fallen away like so many people had thought. Just to remind you, we've been in higher for longer. That's been our mantra for going on the fourth quarter now. So we've been there for about a year. So there's more demand, and that demand has come from the accumulated savings of the massive fiscal spend that occurred post the pandemic or mid the pandemic, but also income driven, right? We've had real wage growth. We still have a very tight labor market. We've been running 5% plus wage growth. That's starting to slow, but you've still had real wage growth and real confidence that comes from that. We've drawn down spendings because of confidence, because of the accumulation of asset wealth with housing. And that really kept everything quite buoyant right through to the end of Q1. The S&P ended up around 10%, and the leadership was very similar to what it was in 2023, where mega cap tech led. Large cap did less well, mid caps did less well, small caps did poorly. And if you read the NFIB, you see that small and medium-sized businesses are struggling. American Express actually had, in their Q1 review, they saw a really strong consumer, and they saw a small and medium-sized businesses that are continuing to weaken. And that rhymes very well with what the NFIB, the small business entity, has been saying for a while. What was different than 2023 is energy actually led. The strongest subsector within the S&P was the XLEs. That's energy. XOP was also, which is the exploration and production names. Those did very well. Obviously, it was driven by the commodity. The commodity has really strengthened quite a bit. We'll talk about that later. But we've been a fan of energy here for a long time. That really hurt us in 2023, but it's been great for us so far this year. One thing to really note is that equities throughout the first quarter were able to work higher despite the Fed cuts. Starting the year at 7 cuts, now we're down to 2. By the end of the first quarter, it was down to about 3. But it really didn't seem to hurt markets until you saw the long end of the curve start to break down. When you saw the 10-year go through 4.5, that's when here early in April, you start to see some meaningful weakness and a correction in equities. And our thesis for some time has been that this market's going to be just fine unless inflation really gets too strong. You really see a lot of pressure at the long end of the curve. And this housing market is going to struggle with 730, 740 mortgage rates. That's been consistent. And I think that is what is really hurting the market and consumer sentiment right now. Now, just for what it's worth, we do have a huge issuance week next week in the belly of the curve. Quite a bit of 2-year, 5-year, and 7-year. Remember, there was a very weak 10-year auction about 2 weeks ago that really set off, I think, some of the weakness in the 10-year, higher yields, and a weaker equity market. So for now, we remain higher for longer. We continue to think that the Fed will cut maybe once or twice this year, but we do see some softening on the consumer side. You are seeing as a result of the higher rates, you are seeing some weakness in housing. You're starting to see some weakness. You see Home Depot trading off recently, and you're seeing some weakness in the housing and the remodeling business. The new housing market is getting weaker. Multifamily is getting much weaker. So we don't see a recession imminent, but we do see some weakness. If you could go forward to the essay Einhorns Epiphany, we wrote an essay in the middle of this quarter, which talked about it's about David Einhorn, and David Einhorn had a conversation on a podcast in the middle of the first quarter that really got a lot of attention, and it's on a theme that we've talked a lot about. He's been influenced by a guy by the name of Michael Green from Simplify, who has done a lot of work and really proven out how much this market has been distorted by passive flows, and how passive flows and ETF flows and flows that are sort of price agnostic, value agnostic. In other words, more dollars flow, the higher the market cap is, as opposed to how a value investor or an investor who just cares about valuations, would behave. So it's changed the behavior of the markets. I don't believe that the market is broken. I think that was kind of the splashy headline, but I think that when you are in an area now where passive flows so dominate the overall market, it probably means that the market will be less efficient over time. And that is Einhorn's point. And he's become more of a trend follower, going after on the long side where he's got more liquidity and accepting that in the small cap and mid cap world, the reversion to value is going to take much longer because you have less active money relative to how much passive money that you have. So that is another thing that keeps us bullish sort of long-term on markets, because we do believe that young people, it has been embedded that you stay invested in equities. When you're a young person, and it's probably the right advice over a long period of time, you're going to outperform, but your starting point matters. It matters very much. And when you're starting at a very high multiple and perhaps even still over earning because of all the fiscal stimulus, you've got risk of maybe going sideways with equity allocations for a longer period of time. Now, one thing that we talk about in this document after that essay is kind of the quandary around employment, right? The Fed seems dovish. Powell seems dovish to the surprise of many. But I think what Powell has been looking at is a lot of employment data, not weekly claims, but other employment data. And we look at the Kansas City Fed Employment Conditions Index, and you can see it really rolling over. And look, history has been very clear. When you start to come off the boil of peak employment, it usually means you're about to have a recession. But there is so much conflicting data around employment, where you have great statistics and pretty weak statistics, right? Quits have come way down. Usually that means that people are less confident in their employment situation, and yet new weekly claims are still very, very low. It seems that the green eye shade guys, as they say, the microeconomists, are struggling with post-pandemic statistics. You have a return of much higher legal immigration. You have higher illegal immigration as well. That seems to be having an impact on the statistics. Seasonality seems to be changing. Youth unemployment, which was part of seasonality, seems to be changing, where it's lower now. Participation seems to be falling. You have a real behavioral change where a lot of older workers, older men, are making the decision from a lifestyle standpoint to work less and move to part-time versus full-time. Maybe it's consulting. So you have a lot of oddities within the labor data that leave a lot of us somewhat in the dark and a little bit nervous that we don't have a great picture of what's going on in employment because of all the conflicting data. So we look at other things within the economy, and overall demand still seems strong, right? We still have income strong. We still have the effects of the wealth effect, but I do think the economy is slowing, despite the fact that the most recent Atlanta Fed GDP now is still running at like 2.8. Inflation is coming down to around 3. So you call it a full-in, all-in NGDP, nominal GDP of around 6%. Well, that's a pretty healthy demand environment. Our concern, again, is that if inflation remains troublesome and the Fed looks like they're too dovish and you get real weakness in the 10-year, I think you'll see weakness in housing. We are at very, very full employment. We are still at highs in terms of residential construction employment. So if we have a fear of a potential recession much later in 2024 and into 2025, we think it will start in a weaker housing market. Let me just very quickly, before I turn it over to you, Drew, mention energy, commodities, and gold. On the energy side, if you've listened to us, you're probably tired of hearing us say it. We think that you have long-term underinvestment, not just in the U.S., but globally in traditional energy growth. We see the energy transition being very, very slow, and we see inexorable demand growth from emerging markets continuing unabated. So you have some unsureness on the supply side, and yet you have inexorable demand. We love copper. That's our favorite metal. We think you got a real opportunity because of the weakness in China in residential real estate, created a bit of a vacuum under copper, but the secular story of global electrification, of data center growth, of all the other drivers of electrical demand, that means copper demand. So we continue to love the copper story long term, and we like gold. We're not gold bugs necessarily. We are people who believe that a diversified portfolio, which includes obviously some of the products that we sell here at WealthVest, like fixed annuities, like fixed index annuities, are part of a defensive long-term allocation. We think gold is as well. The whole world has gone through a long competitive devaluation process. We're not bearish on the dollar. And the reason we're not bearish on the dollar is because the whole world has printed money. The result of that is that longer term, that's a tailwind for commodities, and it's a tailwind for gold. And with that, Drew, I want to turn it over to you.
Thanks, Tim. So we focused quite a bit on AI, and that's because a lot of the gains were from AI when we're looking at equity markets. Whether that exuberance is rational or irrational has yet to play out. But the point is clear that, in 1950, pen was put to paper by the English, computer scientist Alan Turing. And since then, there's been a lot of developments over the past few years. Obviously, in January 2023, Microsoft announced that it was going to put $10 billion into OpenAI. Over the past year, we've seen that TrueMark's AI-based ETF appreciated to the tune of about 52%. And when you look at this graph chart here, you can clearly see where some of the big performers were, right? NVIDIA up well over 80%. We see Meta up 40, Microsoft up 14. So a lot of these, the Magnificent Seven became the Fab Four, and we saw huge gains. When we're looking at a recent global survey, it was 300 businesses were conducted by MIT. Only 9% of these respondents said they were significantly using AI within their industry, and they plan to over the next 5 years. There are big issues to mass adoption right now. We're looking at data privacy, corporate IT budgets, compliance, and regulation. That makes it very difficult. So, the analysts at Goldman noted in a recent letter to shareholders that they see some benefits to a lot of industries. You're looking at data infrastructure, motion picture, sound production. These things might have AI sooner rather than later, but in terms of wide swaths of other industries, adoption remains well below levels necessary to see large aggregate productivity gains. On the international take, we see Europe is definitely in a manufacturing recession. When you're looking at the Purchasing Managers Index, which we mentioned the PMIs a lot. So just to kind of talk about it a little bit, if you're not as familiar with it, it is tracking prevailing direction of economic trends. And really what it is a monthly survey of supply chain managers across 19 different industries. So, Europe kind of sat a little higher at 46.1, contractions at 50. You look at Germany. Germany is deep in a manufacturing recession at 41.9. Overall, when we're looking at where they are in terms of orders and prices paid and everything, that is really, you're looking at coming up on levels that we saw in 2011 to 2013, which was really during the heart of the Greek debt crisis and a euro kind of a collapse in Eurozone, just generally, especially when you were looking at the euro during that time period. China, yes, the Shanghai Stock Exchange was up a little bit, paltry, 2 and change. What the Chinese have really tried to do is export their way out of this. They've spent a lot of money on manufacturing and hard infrastructure as well. The issue is that a lot of countries, Europe, the United States, and everyone else has become a lot more tariff friendly. We've seen there hasn't been a lot of daylight in the Biden administration as there was in Trump. The policy on China and the policy on muscular industrial policy remains very much the same. That will make it difficult for the Chinese to export their way out of it. And in terms of all these investments that they're making, you're really basing this on the assumption that they have to run fiscal deficits at 3.8% of GDP. The issue is a lot of their municipalities are heavily underwater, and in a local level, there's a lot of indebtedness going on in China. Japan, you've seen private consumption's been weak. However, exports remain really strong, and we've seen strong employment levels. Unemployment was hovering around 2.6 in February of this quarter. And that's really, when you look at one of the big unions in Japan, which is Rengo, it's really a compilation of all sorts of industrial unions. They were able to get wage growth above 5% this quarter. So, you're seeing some definitely inflationary measures in terms of wages in Japan, and, the Bank of Japan's going to have to act accordingly. Portfolio analysis. We've talked about this quite a bit at WealthVest over the last several years, but this is an update of our sustainable withdrawal rates for 2024. Bill Bangin and came up with the concept of sustainable withdrawal rates in 1994. In 2015, WealthVest partnered with Dr. Wade Pfau, kind of revisited this and the rule of 4% in terms of we're looking at 4% drawdowns realistically, measured with inflation during retirement. And we're looking at, in today's environment, with increased longevity, with international markets suggesting there's no reason to believe that the U.S. experience can provide confidence about a worst-case scenario, updated fee assumptions. When you take that all to the account, we have, we're looking at newer numbers for a 30-year time horizon and a 40-year time horizon. If you download the white paper, the methodology and is definitely outlined in its appendix. But functionally, we just want to look at what failure rates you are comfortable with, ranging from 5 to 50, and how much of your allocation is in equities. And when you're seeing a 30-year time horizon, 60% equity exposure, if you're comfortable with a 5% risk of failure, you're really looking at close to a 2.3% drawdown that's sustainable. In terms of annuities, a lot of the most recently quarter numbers haven't been updated. So we kind of did a deep dive over the past several years in terms of our sales analysis. But look, fixed rate deferred annuities, obviously over the last few years have benefited substantially from our interest rate environments. So we see two things that can really affect sales going forward. One is what happens with interest rates generally, as these are interest rate derived products, especially fixed rate deferred annuities. But you see that during the past few years, 88% of contracts on a fixed rate deferred annuity basis were in the 3-year and the 5-year. But the other thing that really matters is that longevity is coming at us, or I should say aging demographics are coming at us. And when you're looking at the Retirement Income Institute, we saw that more than 4 million Americans turned 65 in 2023. This trend is expected to continue through 2029. So a lot of people are aging, and that adds much larger market share, as these are the types of potential buyers for these principal protected products. We look at structured notes. Structured notes had a strong start to 2024 with over $26 billion in sales. That was a 5% increase compared to the same year previously. But what we saw was that the VIX returned to pre-pandemic levels, which was below its historical average, and that impacts the competitiveness of these products. We think that with the year, as the year continues, we're just watching for spikes in volatility and swings in interest rates, and that's going to affect the future of these sales. And lastly, we kind of just end on some of the highlights. So, we've got blogs that Tim created, and then we showcase our March 20th town hall with Tim Pierotti. Throughout this quarter, we'll be publishing more blogs, and we'll be publishing, more town halls and more webinars and all the rest. So please be on the lookout for those. And thanks for your time today. Tim, that's all I have. If there's anything else you want to say on this document to close it out, let's do it.
No, well done, Drew. Let's have a great second quarter. Thanks, everybody.
Thanks.